is a reversal pattern that forms at the end of an uptrend after an extensive rally. Because it's a reversal pattern, when the previously rallying market does break out of a double top, price will fall. At the start of a double top, price action is bullish and prices are rising. At a certain point, price will pull back from a high and form a new low. This low becomes the support level, or neckline. The bulls will start buying at the support level, sending price back up to test the previous resistance level. But this time, when prices hit the resistance level and are forced back down, bulls are hesitant to buy again at the support, and prices continue to fall past it. If the support is broken convincingly with a lower low, a double top pattern has formed. The market trend is now reversed, changing from an uptrend to a downtrend. To determine how far the price might fall after a double top pattern, you can use measuring objectives. Measure from the neckline to the top of a double top. Then project this distance downward below the neckline. This is the minimum objective, and it represents the potential price fall. The opposite of a double top pattern is a double bottom pattern. In a double bottom pattern, you'll see two lows at the end of a downtrend, signaling that price is about to reverse and start rising. To project how far prices might rise after a double bottom pattern, measure from the neckline, which is a resistance level in a double bottom pattern, to the support level of the pattern. Then project this distance upward from the neckline. Now, you will not only see when a trend is reversing, but you also get a sense of how far the price will move in a new direction, helping you make educated trading decisions.
A head and shoulders pattern is a key reversal that signals a change in market direction in a bullish market. The pattern consists of three peaks. The first peak is formed when the market defines a new high, but then retreats to a level supported by buying interest, or what's called the neckline. At this point, you can start to see the shape of the left shoulder. The next peak is even higher than the first. It's formed when the market rallies again with aggressive buyers. However, ultimately, it is met with resistance too. The price retreats to the neckline, forming the head. Finally, the market recovers again to form a third peak. This time, buyers are tentative, creating a peak that is equal to or lesser than that of the left shoulder. Eventually, there is a third, lower retreat that breaks the neckline. Once the neckline has been broken definitively, you can see the formation of the right shoulder and confirm that it is a head and shoulders reversal pattern. The opposite of a head and shoulders pattern is called an inverted head and shoulders. It signals a trend reversal in a bearish market and consists of three lows. In an inverted head and shoulders pattern, the left shoulder is formed when the market hits a new low, then moves back up to a resistance level, or neckline. At this resistance, the bears begin to sell, pushing the price to a lower low and forming the inverted head. From there, buyers will push the price back upwards to the neckline, before selling again and forcing the price to another low, forming the right shoulder. When price rises again and definitively breaks the neckline, you'll be able to confirm the inverted head and shoulders pattern. To determine how far the price might rise after either pattern is completed, you can measure from the neckline to the high or low of the head and project that distance from the neckline as your measuring objective. This will help you plan for your next trade.
There are times when price moves within a range without establishing a real trend in one direction or another. This is called a consolidation pattern, and it is often due to market uncertainty. When you use price action trading methodology, you'll focus on two types of consolidation patterns: triangles and rectangles. As with a continuation pattern, a consolidation triangle consists of a series of highs and lows where price is converging over time, but they are usually larger than triangles of a continuation pattern. They are also bound by support and resistance levels. A rectangle consolidation pattern demonstrates a neutral bias between the bulls and the bears, a market in conflict with no clear winning side. They appear as a series of highs and lows bound by parallel horizontal support and resistance levels. For this reason, they may look like flag continuation patterns, but rectangle consolidation patterns do not need to occur after a sharp rally or decline. One important difference to remember with consolidation patterns is that, unlike other patterns we've seen, when a consolidation pattern ends, the market may continue its previous trend or reverse it. Still, if you can identify a consolidation pattern, you may have the opportunity to better position your next trade and take advantage of the moment when the market breaks the pattern.
Triangle consolidation patterns are short-term patterns often found on 1 and 10-minute charts. They're a pause of sorts that occurs when price action tightens into a coil. Triangle consolidation patterns are usually bigger than triangle continuation patterns and do not need to occur after a sharp drop or rise in price. And when the price breaks out of a triangle consolidation pattern, it can go in either direction. It won't necessarily go with the preceding trend. In a triangle consolidation pattern, the triangle shape is made of highs and lows that form smaller ranges as price moves. You can see the triangle clearly by drawing two trend lines. The bottom one, connecting the lows, indicates demand, and the top one, connecting the highs, indicates supply. There are multiple kinds of triangle patterns, each of which will tell you something slightly different about the market. A symmetrical triangle occurs when the trend lines converge towards the center of price, and indicates that buyers and sellers are unsure where the market is headed. In a non-symmetrical triangle, the trend lines converge off-center. If they converge closer to the highs and the uptrend line is steeper, buyers have more control of the market. If they come together closer to the lows and the downtrend line is steeper, the sellers have the advantage. There are also ascending and descending triangles. In an ascending triangle, buyers are more aggressive than sellers, and highs are not significantly higher than one another, which gives the triangle a flat top. A descending triangle is the opposite. Sellers are more aggressive, and the triangle has a flat bottom. You can find your measuring objective by measuring the distance from the first point in the triangle pattern to the extended trend line on the opposite side. Then, project this distance in the direction of the breakout to estimate how far the trend will continue. Understanding the way the market behaves during and after a triangle consolidation pattern will help you predict price action and be better prepared to make smart trades. A rectangle consolidation pattern is usually an indicator of a pause in a market trend. It forms when trading occurs between horizontal support and resistance levels. Unlike continuation patterns and reversal patterns, rectangle consolidation patterns can happen without a sharp rally or drop in price action. Rectangles indicate a market in conflict, where bulls and bears are pulling equal weight and equally affecting price action. When price consolidates into a rectangle pattern, it creates a series of similar highs and a series of similar lows that stay confined to these support and resistance levels for a considerable amount of time. For example, imagine a bullish market in which price acceleration slows. You can see how price consolidation between significant support and resistance levels forms a rectangle pattern. Price moves horizontally, touching the support and resistance levels several times as bulls and bears wield equal power over price. Understanding when prices are in a rectangle pattern will give you a sense of which way the market will move, helping you make trading decisions based on the direction of the market. To calculate the measuring objective of a rectangle consolidation pattern, measure the distance between the resistance and support lines, then project that distance in the direction of the breakout from the pattern. Price charts are full of zigzagging price movements, and though they may seem random to the untrained eye, they're not. The up and down motions are based on support and resistance levels, price boundaries that form based on the psychology of market traders. A support level is like a price floor. It is the price level at which traders are willing to start buying again, and their increased demand will push prices back up. At a support level, traders believe that the price is low enough to overcome pressure to sell, and bulls regain control of the market. The resistance level is at the other extreme. It's like the ceiling. It's the level at which traders are willing to sell, often because they don't think the market will tolerate higher prices. The bears regain control of the market as they start to sell their positions, and prices fall with this increase in supply. Support and resistance levels reflect the market psychology at a given moment in time, but when the market psychology shifts, so do those levels. When a bullish trend pushes prices past a resistance level, this reflects the thinking that demand is strong enough for prices to continue climbing even further. There will still be pressure to sell at some point, but it will be at a level higher than the old resistance level, and new support and resistance levels will likely form. It is important to understand how support and resistance levels work, so that you can use them to trade profitably, rather than relying on your ego to predict traders' willingness to buy or sell.
In the price action trading methodology, you'll look at support and resistance levels in every time frame, but it's best to identify exactly where they are on the 1-minute chart so that you can determine the best level of entry for your trades. To find support and resistance levels, you'll use a straight horizontal line to connect either multiple highs or multiple lows. Due to fluctuations in price, your levels won't be exact, but a good line will touch more than one high or more than one low. For example, on this 1-minute chart, we'll draw a line connecting a series of highs. When we zoom into the 10-second chart for a closer look, we may see moments in which our price doesn't touch the line. That's okay. Even if it's not perfect, your line will still help you identify a zone of support or resistance. The more touch points there are, the more significant your line is. If a line only has one touch point, it hasn't really been tested and can't be confirmed as a support or resistance level. You'll use the current price to determine whether your line is acting as a support or resistance level. If your line is below the current price, it is a support level and it should be in blue. If your line is above the current price, it is a resistance level and it should be in red. Remember, in the price action trading methodology, it's more important to be profitable than to be right. Manage your ego. If you're trying too hard to be exactly right, you'll doubt your lines and overanalyze the chart.
Like other market movements, support and behavior of traders. Bulls, who buy at support levels,